Hello everyone and welcome to Minted, where we go over all things finance. Right now, as you're watching this video, central banks around the world are making decisions that will either make you thousands of dollars richer or poorer over the next few years, and most people have absolutely no clue it's happening. Interest rates control everything from your ability to buy a house to whether your retirement savings will actually last. Yet 90% of people couldn't explain how they work if their financial future depended on it. Here's what the banks and financial institutions don't want you to know about how interest rates really work and how you can use them to your advantage. So, let's begin. What is interest? It's simply the cost of borrowing money from someone else. The cost of borrowing money, or the amount you receive for lending money, is called interest. Interest is usually expressed as an annual percentage of the loan amount. To compensate the lender for lending you money, you'll need to repay more than what you borrowed. The lender will assess you more if you're risky and will pay higher interest rates if you borrow money for a longer period. To give you an example, a loan to purchase a car will result in you owing the loan amount, also known as the principal, and the interest charges by the lender. For example, if your car loan is $10,000 at 6% interest, then you'll have to repay $10,000 and pay the lender $600, the total then being $10,600. This amount will be repaid over time by you to your lender. So then, how do you earn interest? When you deposit money into an interest-bearing account, such as a savings account, you earn interest. Banks do the lending of account deposits. They use the money to make loans and invest. Banks earn money and pass some of it to you as interest. The bank will pay interest on your savings every month or quarter, and your account will be credited with interest payments. You will see the transaction and notice an increase in your balance. Then you have two options. Withdraw the money or keep it in your account and continue earning interest. You can earn interest if you save money. For example, you can earn $30 more in interest if you deposit $1,000 to an account that earns 3% interest. If you only use simple interest after a year, you'll have $1,030 in savings. When you keep your interest in your savings, it can really help build your account balance. Both your original deposit and the interest you earn on it will earn interest. This is called compound interest, which is the addition of interest earned on the interest. Interest and inflation. When central banks raise interest rates, it's big news. The bank is judging that the only way they can try to pull down inflation is to continue raising interest rates. We are going to see rising rates, and rising interest rates will make the cost of borrowing go up. This can send ripples across the whole economy. It can sink consumer confidence, result in fewer jobs and lower wages, and cause stock prices to fall. If they go too far, too fast, it can tip economies into recession. So, why do central banks raise interest rates? Let's start with the basics. If you borrow money, the interest you pay back is to make it worthwhile to the lender so they can keep making money to loan out more and make more. So, if you are taking out a loan, you want the interest rate to be as low as possible so you don't have to pay that much back. On the flip side, if you want to save money, then a high interest rate means you can earn more on your savings. See it as a reward for leaving money in your account. But the size of your reward depends on the circumstances. There's no single interest rate in the economy. You've got thousands of banks setting their own commercial rates. That's all influenced, though, by the interest rate that the central bank sets. A central bank is like a bank for banks. Just like you and your savings account, banks also earn interest when they leave money with the central bank. Commercial banks have these things called reserves, so that's a bit like their cash on hand. Commercial banks lend those excess reserves to each other at an interest rate, and they also can deposit their excess reserves at the central bank. When they do that, they can earn an interest rate. Ordinary people can't access the interest rate on the excess reserves, but it still affects them. And that's the idea. When central banks raise interest rates, they're trying to control inflation, how fast prices rise for everyone. For instance, items that were £1.29 are now £1.39, and that's in the space of 4 weeks. Central banks like the Fed, the Bank of England, or the European Central Bank are all trying to hit an inflation target of 2%. If inflation is seen as too high, that's when banks raise interest rates. Here's how a rise works. Interest rates are a really powerful tool that central banks have to hit an inflation target of 2%. If inflation is seen as too high, that's when banks raise interest rates. The change spreads through the financial system and slows down the rate of inflation. Here's how. A rise in interest rates from a central bank means that a commercial bank will earn more on their reserves. They might make more from keeping their money in a central bank than lending it out. So if they do lend it out, they'll raise their interest rates to make it worth their while. How that affects consumers depends on the economy. Take mortgages. In places like Finland or Australia, lots of people have mortgages with variable interest rates. If you've got a variable rate mortgage, where the interest rate that you pay is linked to the central bank's interest rate, then higher interest rates mean that essentially the higher rate will translate into less cash to spend on other things. Less spare cash means households will spend less, and less spending means businesses will be warier of raising prices. This should lower inflation. In other countries, like America or Canada, a bigger share of mortgages are set at fixed rates. People with fixed rates are protected against the direct effects of an interest rate rise, but will still feel an indirect impact. Higher interest rates mean that mortgages will become more expensive. If that's affecting all new buyers, then house prices will begin to fall, and that will make everyone who owns a home feel poorer, and therefore they might spend less. Lower spending will translate into lower inflation. And it's not just consumers who will tighten the purse strings. When interest rates rise, then businesses will find it more expensive to borrow and invest. That generally means less economic activity. It might mean fewer jobs are created. Fewer jobs and lower wages could mean less money for households, and consumer confidence might suffer, which also means less spending. People are grappling with a decline in real wages, meaning their money buys less. When interest rates rise, that will tend to slow down spending, investment, and generally depress economic activity. Overall, that will make businesses more reluctant to raise their prices, and that will tend to pull back inflation. It sounds straightforward, right? But the trick is judging how far to go. In 1981, the Federal Reserve, America's central bank, allowed interest rates to rise to a whopping 19%. The move curbed inflation, but it led to widespread economic pain, leading to the worst economic mess since the Great Depression. In America, it's been over 70 years since they've managed to get inflation down from over 5% without causing a recession. A little inflation is okay. It keeps the economy moving at a sensible speed. But inflation staying high for too long is a problem. Higher prices mean employees will need higher wages, pushing up costs for businesses. That could drive up prices further, potentially leading to an upward spiral of wages and prices. Retail inflation in India has surged to 7.8%. The combination of tepid economic activity and high inflation poses serious challenges for the Indian economy going forward. Central bankers are really concerned about setting expectations of inflation. The idea is that if they can show that they are credible and will always act to get inflation back down to 2%, then maybe they won't have to raise interest rates and then lower them in this kind of seesaw fashion. Raising interest rates can slow an economy right down. The trouble is, the brake pedal has a delay. It can take as long as 2 years to see the full results from interest rate changes. Central banks know this, so when they set interest rates, they're actually trying to read the road ahead. But predicting the future isn't easy. The problem is, it's difficult for the central bank to work out whether the inflation will fall back on its own. And even when central banks do get it right, they might still cause a crash. It may be a blunt instrument, but raising interest rates is still central banks' main tool for taming inflation. Central bankers would say that, yes, raising interest rates can be painful. Slowing down the economy is not fun, but it's worth it. It's worth it to get low and steady inflation, so that in the long run you don't have to think about it. Thank you for watching.